Let's continue to talk about the markets, get a big picture here. Chris Kempitsis, managing partner at Barnum Financial Group, is with me. Of course, the AI trade has been exciting over the last few years. It's driven the markets. When there were dips, people bought them. And we've had some recent volatility. Do you have a plan on what to do with your AI trades?
Yeah, absolutely. Good to be here, Nicole. When it comes to AI, the reality is that we have not begun to see the tip of the iceberg of how additive this technology can be when it comes to corporate profits and even the consumer potential uses, let alone the corporate uses. So we're tremendously bullish long term. Now, has the easiest money been made? Perhaps that's a fair argument to make, but that doesn't mean that there's not a lot of room to run here in the intermediate and long term.
So when you see names like Google running, NVIDIA pulling back, you look at that. And of course, I had a guest who said, I really like Google today, said, I'm not touching NVIDIA and Tesla because they're just overexposed right now. Are there names in the Mag 7 that stand out to you more than others, or how do you decipher between them?
Yeah, we've liked Google all year, and we continue to do so. Google has been lagging its competitors in the space now for years, and it's finally now getting its moment in the spotlight. And we're seeing what potentially could be a tremendous tee up to 2026 in the work that they're doing and the potential deal that they're about to possibly ink with Meta. It's a great tailwind going forward for sure.
And then you do have a barbell approach, I believe, or you had at some point. Is that still applicable now?
Yeah, it absolutely is. Now is the best possible time to have dry powder in the portfolio and look to take advantage of these dips as they come along. And even a correction is not an unhealthy thing. The market is priced to perfection here, and even wonderful earnings have not been able to quite sustain the current rally. So it's fair to say we're going to see near-term volatility. We want cash on the sidelines. And for clients that have diversified portfolios, a classic rebalance here, a good old-fashioned rebalance, might be just what the doctor ordered to take some profits and buy some of their year-to-date losers. Not a bad thing to employ here.
What about utilities? Where do utilities and maybe some other sectors fit in a portfolio?
Yeah, we love utilities here for the reason that they're going to provide us income while we get paid for the market to settle down and begin its growth story again. And there's a tie, it's an adjacent play to AI because of the need for the energy and resources related to the data centers and the build out that's happening there. So there's a lot to like about utilities, and they have a much lower forward PE ratio than some of the more elevated sectors such as technology.
And then at this point now, when you think about the other areas, for example, staples has been one area showing a little strength. Some of these are real defensive plays. I mean, international, emerging markets and staples. Tell me about those.
Well, there's a lot of different ways to play defense. And one of those is to have cash on the sidelines to buy the dips in your growth names. But the other is to look for areas that are potentially on sale. And that's an approach that we want to take wholeheartedly here. So there's a couple different ways that you can do that. Consumer staples is a sector that's going to rise when the rest of the market, the growth names, are pulling back. You're going to get a healthy dividend, and you're not going to see quite the same level of volatility. Similarly, you might want to consider employing an equal weight S&P index here. So in essence, you're sort of creating a natural rebalance in one fund by getting exposure to a lot of sectors that have pulled back and are really just starting to see a little bit of an advance.
What do you think about the 4% on the 10-year bond yield right now?
Yeah, who knew we would get here just a little while ago? It's interesting to see how we've come so quickly, quite frankly.
I know, that's the whole thing. It's the trajectory that I was thinking, that we were at 414, and it wasn't long ago that we were at 398. We went up, we went down. Ultimately, mortgage rates should probably come down. We've had 3 weeks of gains. I got to see the latest one. But that could help housing and the economy and things like that. How do you feel about the economy right now?
Overall, the economy is starting to show cracks. You look at the data, housing inventory is up something like 15% versus a year ago. And now consumer confidence, the latest reading has plunged. The University of Michigan reading, it was near all-time lows. So that's a major concern. But what people want to keep in mind is that consumer confidence can often be a contrary indicator. So when it goes low, historically, we see the market rally months after. And so that might be a sign that we may be seeing an opportunity to the start of 2026. And I really like that positioning in my portfolio here.
What happened to seasonality? I mean, the Dow's having its worst month since April. November, December, January, usually good news and some Santa Claus rally. Do you expect some more turnaround volatility? Because right now, when you see down arrows for the month, let's say.
Yeah, it's easy to get nervous here. The last time we had a down December was 2018. And look, sometimes the market can't just go up, up, up. It is okay to take a little bit of a breather. But when corporations are registering triple plays, revenues up, profits are up, and they're raising guidance, that's not a sign to be fearful. That's a sign to be prepared. That's a sign to get ready to deploy that cash. It's a sign to be able to take advantage of a rally to come, as far as we can tell, and we're excited about that.
Look, you have names that are doing well today: Merck, Home Depot, Nike, Salesforce, Walmart, some of the best performers on the S&P 500 today. Chris, good to see you. Thank you so much. Chris Campitsis, managing partner of Barnum Financial.